For insight, let's go to our featured guest of the morning. He's Lyle Stein, president of Forvest Global Wealth Management. Thanks for coming in, Lyle. Always good to see you.
Good morning, Paul.
Your view on the debt ceiling talks, first of all, that's the near-term concern of markets.
It has been, and it is. It's one of these 0-1 events. It either happens or it doesn't. But if this debt ceiling would not be resolved, it would be financial Armageddon. And so it's good news. And you know, the market always knew it was going to happen, but you just don't know that slight little chance that something bad would happen. And so this is great news that things are going to be pushed on. You know, it's kind of delay and pray, as they say, but at least it's going to be resolved for now.
You expect a deal?
Yeah, I expect a deal. I mean, of some sort. I wouldn't even want to hazard a guess as to what it's going to be. It's probably just going to be pushed out a bit, just because that's the easiest thing to do. Okay,
longer term, of course, inflation is the worry and the central bank response to inflation. We got, as I said earlier, a reminder yesterday right here in Canada when the latest inflation figures showed that it's not easy for central banks to bring it all the way back down to 2. Inflation ran at almost 4.5% here in Canada during April, exceeding economists' expectations and ticking up from the pace of growth in inflation in March.
Yeah, exactly. And this is problematic. Getting to that magic 2% is now going to prove difficult. You know, we saw the uptick in Canada. We've seen wages very, very sticky in Europe. And actually, it was a couple of weeks ago, we got surprised by the Central Bank of Australia, which raised rates because they needed to get this inflation genie back into the bottle. And what we're seeing now are wage settlements. And you look at the government wage settlement in Canada, it sets a precedent that inflation is going to be locked in at higher levels. And that's exactly what the central banks want to fight.
What about the markets themselves being led higher by growth stocks so far this year? The NASDAQ composite of the 3 main indices in the United States, by far the strongest so far this year.
Well, there's 2 reasons to this. Number one, it's been the big cap behemoths, the Apples, Amazons, Googles, Microsofts of the world that have taken this market higher. The interesting thing, though, and we just looked at this at our global investment meeting that we had yesterday, is these stocks are still not back at the levels they were in the fall of 2021. And so all we've really seen with the big cap tech stocks is a multiple contraction and a multiple expansion. Why did the multiple expand? It's because interest rates and interest rate expectations have fallen down, and tech stocks are long-duration assets, no different than a 30-year bond.
NASDAQ composite, as we saw, up about 4.5% over 52 weeks. It's up 18% year to date. So the rally has been pronounced. What are we seeing elsewhere in the equity markets?
Well, I think that's the big debate right now. It centers around interest rates. Are interest rates down, and expectations are that interest rates will continue to fall? And there's a big gap. The central bank, the Fed, in their dot plot says we believe rates are going to be 1% higher than what the market is expecting 12 months from now, 18 months from now. That gap has got to be closed. Now, is it closed because recession drives rates down, the Fed dot plot falls, and then they respond to the recession? Or will it be resolved by the market saying, wait a minute, we're not going to get to the magic 2. We better raise our expectations. That's the debate that's going on in the market, and it's showing up all over the place.
The U.S. consumer is so important to the U.S. economy. We have a retailing expert coming on later in the program. She's going to argue that U.S. consumers are indicating that the U.S. economy is either in or will be in shortly a recession. What is your view of the state of the U.S. consumer right now?
The U.S. consumer has had a wonderful windfall that came through the pandemic, but a lot of that has been spent. And, you know, averages really confuse the numbers because they don't mention the man on the street. An average includes a Bezos and a Bill Gates. It doesn't include the guy who's getting by day to day, the single mom in Des Moines. And the single mom in Des Moines, the guy who's just getting by, isn't spending. And that's what you're seeing in the kind of numbers that you see at Target. LVMHs of the world, they're doing just fine. But it's where the average person is spending, and that's slowing down.
It's pretty persistent, isn't it? Home Depot, Target, and Canadian Tire, 3 big retailers, 2 in the U.S., 1 in Canada, all reporting dismal results in the very recent past.
Yeah, and it's disappointing. But that is exactly what the Fed is trying to do. And the difficult spot that central banks find themselves in is they want to slow down the real economy to get inflation out. But to do so, raising rates wrecks the financial economy. And over the last 30, 40 years, as interest rates went down, the financial economy became so great that now a move in interest rates is more damaging through its secondary effect of rising mortgage costs and the like that we're having these problems.